So we pretty well covered, mean reversion style trading or outside in. Gave you some examples, shown you kind of basics on pretty straightforward ways to work money management. Now let's talk about this other, a little bit more about this other way of trading, the setups, where I'm trading almost what I would call, kickbacks against a downtrend. So the market's in a downtrend, it gives you a kickback and it starts rotating and you engage, use the mid band to take partial and the outer band to take remainders in a segmented scale out, or you can just leave it all on until you get to the other side or get to some sort of kickback against that. So in other words, if I've entered a trade, so price is above the mid band or above, so this is the area, the value area to be a seller, price action above the mid band, the main bands have been downward for a while now, and I get the fast bands to rotate. So both bands rotate. Let's say I engage price somewhere in this area price in a market order. I have a stop. Say I have a stop up in this area. That's my 1 unit of risk. So that's my first R. When they say R to R, what is my risk to reward? And the good thing, the natural average of these trades from an entry to the other side is way over 3 to 1. So that's really good, meaning if you're working these kind of setups, you have a naturally high amount of reward for every unit of risk that you put on. So if I'm in the trade and I've entered in this area price and I have my stop somewhere up here, the market tags midband. I've taken some portion of the trade off. So let's say I'm trading in units of 3. I might take a third of my trade off and let 2/3 run. My stop at the midband touch, I definitely want to move it to break even plus. Now it's running away from me. And what I'm looking for here is at any point before we get to the outer side of the main bands, am I getting both of the fast bands to hook? Here I had this portion hook, but not this one. So that means I can stay in the trade. Obviously, if I'm in any trade here, I have my stop in place. I've taken some off at midband. Here, this portion of the fast band hooked, this one didn't. So stay in that trade. Now I'm getting price and the fast bands having an excursion outside, then I get the hook, now I can get out. Now I get out as it bounces. So if I short it again, the main bands are relatively still down. We get this lift and we get a hook. Let's say I sell it again. At mid-band, I take a little off and I'm in a trade. If that's hooking the fast bands before we hit the other side, bail on that trade. Call it done. Here, doing a mean reversion trade, we get the hook. I've entered the trade, stop, trade to mid-band, take some off, stop goes to break even plus. I'm in, and I actually get some upward hook right here and here. That's an area to bail on the trade, or at a minimum, I don't want to just have, I took some off and I now have my stop at break even plus. At least lock in 1 to 1 or 2 to 1, and it either works or it doesn't. If it comes up and ticks you out, oh well, hey, I still made 2 to 1 on my remainders. If your 2 to 1 was here and somehow it missed you and then it goes the other side of the bands, then when you get the hook, you take out the rest. You can handle your in-trade management as passively or as hyper attentive as you want. So you can hyper manage these trades or you can passively. In the beginning, you might want to have a little bit more, I shouldn't say hyper, but more active management. And then as you get used to it and you dial in the time frame and the bar type, you could use the grid bars for these trades. You could use the grid Renko. You could use a Unirenko, a Ninja Renko. You could use a Heikin-Ashi candle. You can use time-based volume. The bands don't care. The iGrid bands indicator doesn't care what time frame you're on, and it doesn't care what bar type. Now let's talk about some other types of trades. And these are some of the patterns that I'll look for when I'm working these type of trades. See how we have this bounce? So let's say the market had a really big sell-off, and I'm not all that excited about jumping in here and buying. Maybe there's a level just below, and I'm thinking, yeah, this baby's going to eventually tag the level, then I'll think about being a buyer. But after that, the market bounces, holds a bit, and then see how I get a little bit of a pullback here, and then the fast bands hook. So both fast bands hook, that's where I put the blue line, that would be my entry. So I just had a market basically now that's stair-stepping higher, and I'm starting to develop. You can see from this point going forward, the main bands are upward. So I should be trading the long side. So that's kind of like getting a pullback in an uptrend. I got the bounce after selling. Selling has dissipated and then ended. We've stabilized. The market's holding a pricing area, and now it's lifting. That would be an area where you could take, I don't want to really say it's like a trend continuation trade, but it's getting into a trade in the beginning of a developing trend. So those are trades. Here's one. You get a pullback. It's below the mid band. And if I could have gotten my entry, in the value area, that would be a pullback and lift I'd engage. The only problem I don't like about this is the price position. My entry is basically right at mid band. That is too far away from value. If that pullback was deeper and hooked and I could get in and price, some distance, not right at mid-band, but below mid-band or lower, then I'd be willing to engage. So that's a trade I'd actually not be willing to take. So another thing, though, as far as this blue line goes, I see that the faster band here on a mean reversion inside-out trade hugged, and I got a hook downward, and I entered short, and my stop's up here. If I ever see both bands on the faster bands hook upward, I can bail on that trade. So it's like, oh, mean reversion, no, market's not breaking down, and I'm out of here. Both sides of the faster bands are hooking upward, and I'm short. You can use that to bail on the trade and wait for a new setup. You got a new setup later in here, and that one, got you to mid-band, and I think it kept breaking down. So anyhow, I do pay attention to that with the bands once I'm in a trade. In the beginning phase, before I move my stop to break even plus. Now another way that I use these bands is I look for a pinch in the faster bands. So, let's say I had a level sweep. I swept a level or tested a level, get the bounce. I see the market hold a bit, and then the market starts grinding upward, and I get a pinch between the faster bands. I watch for that. And see this? I want to be, if I'm going to be a buyer, I want it to be below the mid band of the main bands or below. That's my value area to be a buyer. I never want to be a buyer above the mid band. If you want to do that, you can do it. That's not my kind of trading. That's not for me. So in this area, though, the bands are pinching and price is getting linear. I can get an entry in here, and I'm below the mid band to be a buyer, and I can put a stop just below one of these, most recent price pivots. Usually, when the bands start pinching, you get some follow through after that. It's not like you get pinched and then it just dies. The predominance of time, you're in a market that's, it's stabilized to sell off, it consolidated, and now it's moving towards what I call linear price run, where the institutionals are basically in, they're buying 0DTE options, they're buying regular options, they're buying baskets of stocks, they're buying futures. This is all done automated, and the market gets very linear. That happens a lot out of a market that just got done reversing, stabilizing, and starting to grind away from the prior reversal. So you can look for that. You don't have to even engage reversals. You can look for pullbacks and uptrends to engage, or you can look for a pinch in the faster bands and throw some liquidity at a pinch if it's in a proper area of the main bands to be a buyer from a value standpoint. See, if you're buying the market and the dynamic range is being shown to you, displayed bar by bar by the main bands, it's showing you how to get into the market at wholesale pricing levels to be a buyer. So anything below the mid band, when the main bands are pointed upward, that's wholesale. If you're buying above the mid band, you're paying retail to get into the market. So when you go to the Ford dealership and want to buy a 2025 F-150 Tremor with the 3.5 twin turbo, do you want to pay $6,500 below sticker because their lot's got 123 trucks on it? Or do you want to be that guy that, hey, it's a 2025. We'll give you a discount on the 2024, but the 2025s, we're at sticker plus 2,500. Oh, okay, I'll buy it. So do you want to be the smart buyer or the bad buyer from a value standpoint? So all the market is, it's an auction market. It's an auction. You know, who's willing to pay what and at what areas of price. But when you see the market doing the pinch, it's telling you, and you can see it went from sideways price after a V bottom bounce, the grinding price action where they're slowly working in more liquidity before they really go full guns blazing and run buy program activity on the institutional side. The investment banks, the hedge funds start coming in and pumping buy programs. That pinch will tell you when the market's accelerating. You got a pinch starting here, but it's below the mid band, so that's not the proper value area to be a buyer or seller. And these pinches happen all over the place. So I don't care, you can go on a wide range of bar types and time frames and you'll see these pinches. So I kind of have I know on my particular time frame that I use and my bar type how wide that area is where I am already seeing this. It's almost like looking for a funnel cloud. Like I'm from Minnesota, so I know funnel clouds. I've been on a lake that had a tornado right following the edge of the lake, so I know what a hook cloud and funnel clouds. I've seen tons of them in my life, and in Texas too. I'm watching that like, ooh, we're lifting. Here's 7:30. We're pre-market. Okay, it's pinching. Okay, I'm gonna do some buying right here. I'm gonna put a stop in here, and we're coming up to the 8:30 U.S. Central Time open. By then, she's already running, and right out of the open, it keeps on going. So that's another way you can use the bands. Look for the pinch and join a market that's already got some flow to it and some building momentum. This is building momentum. The pinch is the building momentum, and the really narrow, I guess you could say the narrow pinch of the bands. This is runaway momentum, like really strong institutional driven buy program activity momentum type stuff. They're coming in and buying futures or options or stocks or all together at the same time, juicing price. And you'll see big pinches all over the place and big sell-offs. I mean, we just had a big sell-off the other day, and I had 3 pinches. I just threw liquidity in, it just to the short side and just ran away from my entries. So quick summary, there's 3 types of ways that I've shown so far you can use a bands. You can do mean reversion, outside in trading. You can sell kickbacks and downtrends. You can buy pullbacks and uptrends, or you can look for pinch activity and jump into building momentum. So there you have it. That's part 1 and 2 of how to use the iGrid bands And if you have any questions, info@gridalgo.com. Have a great day.